Hello guys, welcome back to the channel. I hope you are doing well. Hope you are doing fantastic. I hope your families are okay. So I've got a number of you guys that are asking me to make one more video about the difference between market structure break or shift in market structure and the liquidity grab. I've got many videos on my channel. I talk about the difference, but it seems that many of you are still struggling to identify the difference between a shift in market structure and when price is basically grabbing liquidity or um, running on sell stops or buy stops. Okay, so now, but before I dive into this, please remember that I'm not a financial advisor. I am not permitted to give any financial advice, so please do not use my content as a financial advice. All right, and of course, let me also say this, that I am um I'm a student of ICT, and everything I share here is not of my own discovery. These are things I learned from ICT, the InnerCircle trader. You can follow him on Twitter. He's on Twitter and then on YouTube. So um and of course I invested in so much time to understand his concepts, and until by the grace of God I was able to come up with a trading model, but based on the knowledge of the inner circle trader. So I am not some kind of what is that, this is not my own revelation, guys, even though I do agree that I have a good and a deeper understanding into the ICT concepts. Okay, so let's dive into this. So we're gonna talk about sorry, difference between shift, no, break, BOS, break of market structure, and liquidity, liquidity grab. So this is what we are going to talk about, right? I have explained this many times in my past videos, but many of you are still struggling with this. So let me make one more video and explain the difference between a shift in market structure and a grab of liquidity. So if we have a bullish market, we are making highs, breaking highs, lows, and we break highs, right? Let me zoom in. This is a bullish market. Now, let's say we have a point of value. Let's say we have a liquidity pool right here. This candle closes here, right? And then we have price pouring down here, and then we do something like this. Okay, now if you compare the kind of breaks price was making from here and here and here, and then you compare it to this break and where this move is closing, let's say the last candles, let's say this is on the 1 hour time frame, the last candles, you see how they close from at this area right here, and this is a swing high. If this is a breaking market structure, we want to see a similar move. We want to see a similar move, energetic move, right? After a break of that structure, we want to see an energetic move to the upside, right? But if we see a move, a small move above this swing high, and we see price coming back in this range, okay? If the move from here to here is about 90 pips, another move from here to here is about close to 100 pips. Why is it that the move that broke this structure, right? We saw that from this level, from this high to here is about 90 pips, right? And from here to here, 90 pips. Why is it that from here to here is only 10 pips? So what I'm trying to say is when there is a grab of liquidity, price is going to tap. It's a small move, a tiny move that is going to happen above that swing high, the old low, the old high, previous days high, previous days low, sessions highs and lows, and old highs and lows, right? Supplies, and then some swing highs and lows as well. So price is going to make a small move above that high, and then it's going to return and close and go back in that trend, in that trading range, right? If it is a break of market structure, we will see this move continue up before we return in this trading range. Then when we see this energetic move that broke this structure, then we understand that this market has an intention to continue going up, right? But if you see a small move, above this swing high, and then price comes back in this trading range, it becomes a grab of liquidity. So if this is EU, as you can see, this is the Euro USD, there is no way such a move of 90 pips can be called as can be referred to as a grab of liquidity above this high. So it has to be, if you are trading currencies, the grab of liquidity has to be something that is less than 30 pips, probably 20, 25 pips, 15 pips. But if you see a move of 40, 50 pips, it is likely to be a grab, a break in the market structure and not a liquidity grab, right? I'm going to show you examples on the chart, but I want to make sure that you understand what I'm trying to explain. All right. So before I go to the charts, I'm gonna show you another example. Now, let's think of it. Let's say this is where price closed yesterday. So this becomes previous days high, and then this becomes, let's say, previous days low. So this was the trading range for the previous day, right? It could be previous week, it could be previous month, it could be the trading range for a particular session, right? But Let's say, for instance, this is a full day of trading. So this is a range for a full day. Now we see the new day, right? Starting to do things like this, right? Let's say that is Asian session, right? And then it leaves some kind of equal highs, and then just few minutes before London opens, let's say this is Asia, or maybe even during London session, we see a move above previous day's high with a tiny move above it. All right, so mind you, this is a new day, so I'm gonna put what is that? Yeah, so I'm gonna put this vertical line here, right? So this is a new day. This is where price closed yesterday, and this happens to be the previous day's high. Now Asian session starts high, makes a low, right? And then returns back up, and then let's say London opens here, right? And then this move goes above previous day's high and the Asian high. You can measure the movements that were happening in this day, which happens to be yesterday, and you compare it with this break from, not from here, but from the high of the previous day, and measure in pips. If it is about, this is like 15 pips, and then immediately price is gonna start coming down again, and then we break this low right here. We break this low, right? Now, once you see this tiny move, this is what is known as the ICT T.O.T. It is a small, it's more like a spike or a tap. It's a tiny move above liquidity pools. All right, you already understand what a liquidity pool is. So it's a small move above the highs or the lows where the liquidity pools resides, and then price returns back into the trading range, right? And one of the best ways to confirm that this was actually a grab of liquidity is that price is going to break a structure and then return back to mitigate this mitigation block. Hope this is going to be making sense. So basically, a grab of liquidity is a small move above or below a liquidity pool. A tiny move above or below a liquidity pool. The liquidity pool could be, for example, an odd high or an odd low. So a small move above it and price returns in that trading range, it becomes a liquidity grab. And when price continues moving up over 40, 30, 50, 60 pips, then that becomes a break of market structure. So we are on the daily time frame on the EU, and I'm going to be giving you examples right here on this chart. Now, starting from here, which was in February this year, right? Let me zoom in because I want this to be so clear to you guys. I want that once you watch this video, you'll be able to identify the difference between shift in structure, break of market structure, and a grab of liquidity. So I want you to answer me if I put a horizontal line above this high, right? If you want, you can pause the video and then answer this to yourself. Was this a grab of liquidity or a break in market structure? If we measure from here to here, this is 10 pips and this is on the daily time frame. This small move above these highs, it's 10 pips, and then price came back into the trading range. So was that a break in structure or a grab of liquidity? Of course, that was a grab of liquidity, and then the break of market structure happened. We have a breaking structure here, and we have another breaking structure here. Now answer me here. If I take this horizontal line and put it above these equal highs, is this a breaking structure or a grab of liquidity? Now you're gonna argue that because we see 1, 2, 3 bullish candles closing above, so that's a break in market structure. But this is on the daily time frame. Remember, it doesn't have to be a wick above. It's possible to see a full candle closing above, but we don't want to see a continuation to the upside. Let me repeat that. It can be a wick, right? It can be a full candle closing above, but what we don't want to see is a continuation of this bullish move to the upside. Before I continue on this example, I'm gonna show you this and I'll come back to this. We see price going down, breaking structures. We see these highs here on the daily, and we see this bullish candle above. Did we close above the highs? Yes, we did. So is that a breaking structure or a grab of liquidity? The only way to know is to measure the move that has happened above these highs. So from here to here, that is 20 pips. 20 pips for the daily time frame, that is nothing. That is nothing. And then we see the following day, what happened? Price went down. Massive move of 150 pips to the downside. So was this a breaking structure or a grab of liquidity? It was a grab of liquidity. If you measure the move from here and then you measure the move from this high to here, this is nothing. So this is how we know that price is grabbing liquidity, because the following day came back in the trading range, and it is your responsibility to go down on the lower time frame and look for a setup in here. And once you find the setup in here, then you're going to look for an entry. The setup for entry differs from having an entry. You can have a setup but no entry. Price can give you a setup, but it doesn't give you the chance to enter the market. Your entry can be violated, okay? But I'm not going to talk about this. I'm going to focus on this. So price comes in here back in this trading range. So now we understand that this was not a break in structure. This was a grab of liquidity. If we had seen prices continue here, even if price was going to start coming back, we would know that price is coming to mitigate this structure that was broken to continue up. So now I'm going to come back to this example below here. So that means, and then one thing you should observe here was that we were in accumulation. This is accumulation, this is consolidation. Okay, this is a consolidation. It is not a structure. This is a consolidation. Orders are being accumulated. And now Here you can even see an example to the ICT Judas swing. Price taps below, consolidation taps above, then we dip, right? And then price comes back here to this candle that started this move above. So this becomes the ICT bearish order block right here, and then price, boom, fell. You see that? No, I'm gonna show it to you this way. Look at this. Price came back to the opening of this candle right here to a pip. Look at this, and then price fell because this is the ICT order block. 1, 2, these two candles. So if price comes back in this trading range, we know this was a grab of liquidity, and also we have liquidity void here. Let's continue. I'm going to give you more examples. Now we break. Now, in here, because we have grabbed the liquidity, here is a breaking structure. Why? Because the order flow is bearish. The order flow is bearish. But a perfect breaking structure, the perfect one, better than this one, is this one here. Because after we break this low, look at the move. We had a big move, right? I'll give you more examples. Here, we already know that the order flow is bearish. We have this swing high. Look at this. Look at this. If you see this, about 30 pips, is that a breaking structure or a grab of liquidity? This is a grab of liquidity. So it's a small move above or below where liquidity pool resides. A small move. We grab liquidity in here. If you want, you can go on the lower time frame to see what has happened. You see, this is H4. Let's use H1. Let's check this. Where is that? Here. What do you see? A small move, and in H, this whole move you see up is Asian session, and then we break from this candle, here. From this candle here, you see the low, the opening. We broke this high, grabbing liquidity, and the Asian session is fooling people right here, thinking the price is gonna go bullish. We come back in the trading range, and then this move came back to the low of the bullish candle, the ICT, order block, came below, rejected, and price continued to the downside. All right. Then where did we break structure? Right here. Let me correct myself, guys. This here was not a breaking structure. This was also a grab of liquidity. Let me correct myself. This was a grab of liquidity, but price had to go back up to test this high. And when price failed to take out that high, they grabbed liquidity above these highs here. After you see this candle this week, then price came and broke structure. So I beg your pardon. Now let's continue. After this has happened, we break structure here. Look at the move. So you can compare this small move here and this move, and then I mean it's so simple. Which one is a grab of liquidity and which one is a break of structure? Okay, so I'm gonna look for more examples here. When you look at this, does this look like a grab of liquidity or a break in structure? When this candle went above here, so this is not a break in structure. This is a liquidity grab. The structure was broken here because after it was broken, you can see price came down here. And then price went back up to mitigate any orders in here, and then price continued to the downside. And then here again, we break the structure after price has grabbed the liquidity above these highs, right? Now let me take you to much smaller time frame, H4. You see, let me show you from here. Price came to this low, we tap below it, a small move, a tiny move below this low, and then price went up and we break structure. Now, this is not a breaking structure, but it is a liquidity grab. So if you were to go on the smaller time frame to look for a setup to buy, because whenever they are grabbing liquidity, if they are grabbing sell side liquidity, as price is going down, they are actually accumulating buys, right? And if price is grabbing buy side liquidity, as price is going up and people are placing buys, they are actually accumulating sell orders, they are entering sales. Okay, so then if you see this move here, this is a grab of liquidity and price came back down again to mitigate the orders, and then price continued up. If you see here, this is a grab of liquidity. You see, a small move below this consolidation, and then price goes up, we grab liquidity above again, right? What happens? This becomes a Judas swing, and then price returns to the order block. We touch the order block, and then price continue to the upside. And these annotations you see here, I didn't put them today. They have been there for so long. Every time I see a breaking structure, I put the mark, a grab of liquidity, I put the mark. Now, because here we see a much bigger grab of liquidity. Why? Because this swing high is of a higher time frame on the daily. And if you check on the daily, it's a single candle, bullish candle, one bullish candle that closed above, and then the next candle is a bearish candle that closed below it. You see that? So this is also a grab of liquidity from this swing high. I go to the H1. Now you can see pure break of market structures. A breaking structure. Here we have a breaking structure, price returns. We grab liquidity. We come here, we have news, a spike, and then we have a bit of confusion because all this was because of news, even here. Alright, let me go to M15. I show you one or two examples. For example, look at this. Let me show you. Let me use session breaks. You see, this is a new day starting from here. This is previous day's high. This is like the first example I gave you, if you remember the first example I gave you. So price goes above previous day's high. This is Asian session. And then one candle, only one candle, and then price returns back in this trading range. And then when you come to the charts, you say price has broken structure. It is not a break in market structure. The break of market structure happened here. This moved the downside, that is a breaking structure. Then what happened? Price returns back in this structure. And then price breaks another structure. And now this is where London session opens on this candle. We go up in this mitigation block. Price fails. You find your entry in here. This is where you find your entry. Okay, but we're not talking about entries. We're talking about the difference between structure break and grab of liquidity. So price returns in here. We find entry. We break structure. We have taken liquidity from here. We sell. We break another structure. Price returns in here. We look for entry. We continue to sell. As simple as that. The only grab of liquidity I can show you in here is this move here. You see, we made this high, price breaks it with one candle, and then immediately we have another bearish candle that came back in this range. So you go in here, you look for entry to sell, or you can wait for price to break this low and then it comes back in here to mitigate, and then you continue selling. As simple as that. So there is no confusion in here, guys. This is so simple to identify in the markets. The grab of liquidity, is a small move above or below liquidity pools. This is a liquidity pool here, and we have a small move above, then price came back in this range, and then price went down. But a breaking structure, price has to continue. Price has to continue, and then at some point, price has to start coming back to mitigate before it can continue to the upside. Not so difficult. Not so difficult, right? Not so difficult. Let me pull NASDAQ and see if I can also show you one or two examples on NASDAQ. If I start from here, with NASDAQ, would you call this a breaking structure? Price came to this liquidity pool, and although we have only one small move, to the downside, and then price went back in the same trading range. But a breaking structure, we see it here. A breaking structure, we see it here. Now I want you to take this move, and compare it with this. Now do the comparison and tell me which one is a grab of liquidity and which one is a breaking structure. It's so simple. So simple. I'll show you one more example. In here, this is on the daily price. You see this high? You see this high? Now, would you call this move as a breaking structure? No. It came back in our trading range. That's a grab of liquidity. It's simple, guys. It's so simple. So, whenever you see price going to your point of value, like pool of liquidity, because pool of liquidities, they act as magnets to the price, right? Price is gonna run towards those liquidity pools as long as you are highlighting the right liquidity pools. Whenever price approaches that area, just watch what price does. It's gonna tap up or below, and then price is gonna come back in the trading range and then go to the lower time frame and look for entry. It could be something like this. It could be the price has gone, is going like this, boom, a small move above your liquidity pool, and then let's switch to a much smaller time frame. Let's say price comes back in here, and now you go to a much smaller time frame. Okay, price is gonna do this, and now it's making new lows, new structures. It could be something like this, and then you go in here, you look for sales, right? Another scenario, it could be that, I'll show you, it could be that price is gonna come, break this low that produced this liquidity grab like this, and then price is going to return in here. Now you, my friend, you have a confirmation. Price has broken a structure, and now it is your duty to go in here and look for an entry to sell. Now you ask, what am I going to look for in here? It could be, number one, it could be fair value gaps. I don't know what you trade. It could be an order block. It could be a breaker. It could be liquidity void. It could be, I mean, there has to be um, premium. There's premium and discount. I cannot tell you what you have to look for because people trade different stuff. Some people trade off based on breakers on order blocks, others on fair value gaps. Like the 2022 model, ICT model, you have to go in here and look for fair value gap. When the price returns in there, you short. So, I mean, this is so simple, right? So simple, guys. So I hope this video has made some sense, and I hope that it has cleared your questions on the difference between shifting structure or breaking market structure, whichever you call it, and a grab of liquidity. So my next video is probably going to be on prop firms, on how to get funded, right? Maybe the new video is going to be for those who have a model already. If you have a model that is winning, that is working, stop looking and just start acting. Going on the demo. You've got to know when you have to stop searching and start utilizing what you already know. So, okay, guys, until next time, stay blessed and may God bless you all.